Okay, let's go design a mutual fund portfolio. This video is going to do how to design a mutual funds portfolio. This is going to show you how a user can design a decent or almost great mutual funds portfolio of actively managed funds, and also show you how to do a decent passive portfolios. Let's continue here. Okay, I'm Sarwan Agrawal. Let's continue. I did. Let's look at outline. First section is on assets and basics of portfolio. Second section, and sample model portfolios in the third section. Rules of thumb for portfolio construction in next section. After that, when you learn rules for portfolio construction, at this time you get a good fair understanding of how a portfolio looks like. Then we will build a passive portfolios. Okay, and then we would do a selecting funds. This is where you do research into mutual funds and select some funds for implementing your portfolio. Let's continue here. Then we'll build active portfolios. We'll use selected mutual funds to build a actively managed portfolio, okay, to meet a certain target. Let's continue. Targets are usually given by risk tolerance and time horizon, and portfolio designed by an engineer. Then I will share how I design a portfolio and will show you a. So who is this target audience? Who can benefit from these presentations? Let's continue here. Who, who can benefit from this presentation? Okay, let's continue. The presentation is for folks who wish to start investing in mutual funds or maybe move into active portfolios. Okay. I start from assets and lead the user into designing mutual funds portfolio. And this presentation uses only freely available tools. I show you only the tools, those are freely available. Okay. Passive portfolio section prepares investor for building a decent passive portfolio so to meet your risk tolerance. Okay. Active portfolio section prepares investors to design a superior portfolio to match target allocations. So we will design a superior portfolios to match a target allocation. It's a portfolio superior because it's using the funds we selected through research. So it's research based allocation into active portfolio. Let's continue. What assets are? An investor needs to decide on allocation of assets. So we need assets here based on his or her risk tolerance. The two basic assets. They are basically two basic assets in a portfolio. Okay. One of them is stocks, which is also called equities. The other is bonds and cash, which are also called debt. So equity is its ownership and debt is a loan. Okay. Let's continue here. A higher allocation to equities, which is stocks, stock funds, and stock ETFs, is generally more volatile, is more risky. Some advisors do use some exotic assets like EMBB, emerging markets beyond BRICS. Okay, and in my opinion, that is like a child who wish to have the newest toy. So this newest ETF shows up in the market. Some advisors just want to have that in their portfolio. Okay, let's continue. I stick to the basics, which are stocks, US and non-US, and bonds, which is I use the intermediate term bond and total return bond, usually US only, and optionally real estate investment trusts, and optionally high yield bonds. Okay, let's continue. So we have stocks, we have bonds, and maybe real estate investment trust, maybe a high yield bond. So now we have to look through risk return trade-offs to figure out what is a reasonable portfolio for any investor to meet their risk tolerance. So bonds Bonds are less volatile and stocks usually outperform bonds and have higher volatility, which is a standard deviation and also called risk. So bonds have lesser risk and returns are also not as great. Stocks, equities outperform and have a higher risk. Let's continue here. Because this conflict, it must be possible to design a portfolio with decent return at acceptable standard deviation, acceptable risk. So we can design a portfolio with a decent return at a acceptable risk. Let's continue here. For that, we are considering a chart. So how do we decide where do we want to operate? We'll consider a chart to show you in the following pages and a table. Okay, and if you want to do the chart yourself, this is what tool I use, Easy Backtest, and you can download that from this website here, easybacktest.blogspot.com. Okay, and there are two places you can download from. Just download from a pie chart. Okay, use the pie chart for download. Let us continue from here. Here is the return versus risk. This is return here. This is risk given by standard deviation of various allocations of stocks and bonds. This farthest out is the very first point is for 0% stock, and this last point is for 100% stocks. Okay, so you're looking around here. So this is around this one or that one is probably the best combination, which gives you a returns of about 6.5–7% per year annually. This is a 10-year chart, and return standard deviation is 11.5. Okay, let's continue from here. Whereas 18 is the standard deviation of 17 plus is the standard deviation of S&P 500. So we work around here. Two-third or a little before that. Two-third is this point here. So this 190, 80, 70% stocks. This is probably 60% stocks. Okay, let's continue. Here is the data in a table here. Okay, here is the 10-year chart here, 10-year data, and this is a percentage of stocks, and here returns percentage per year, standard deviation, which is percentage per year, Sharpe ratio, and here DQ here. Okay. Okay, so this is about the least standard deviation you have. So for the least standard deviation, 3.24 and 3.25 are close. So we just use that one here. That means that you can have is 5% stocks gives you about the least standard deviation. Okay, and at that deviation, standard deviation, return is 5.2% per year. Standard deviation is 3.25% per year. Okay, here is a 20% stock allocation results. For 20% stock allocation results, standard deviation is 4.16, very good. Okay, and just like bonds, and 5.92% per year is the return. And Sharpe ratio is 1.18 and 1.42 is desirability quotient. This 20% portfolio, I read someplace in a portfolio book, is the portfolio which has a least chance of losing money in any calendar year. So with 20% portfolio of the stocks, the portfolio is likely to have a positive returns almost every year. Here is a 40-60 40% stock, 60% bonds, and return is at this point higher than the standard deviation. Return is 6.75% and standard deviation is 6.67% per year. Going forward further into stocks, returns go up and so do the standard deviation. Look in here, returns and standard deviation is about equal, with the return being higher, and when 100% stocks standard deviation is twice as much as so the return is, okay, even higher than twice as much. Okay? So you'll have to figure out where you're comfortable with. Standard deviation is bad, you want to reduce that, and returns are good, you want to increase that. So this is 60-40 portfolio that used to be called balanced portfolio in classical investing. So that has a 7.42% per year return on the 10-year basis, ending on 14th July 2014, and the standard deviation is 9.79. Okay, and 50-50 will get you 7.10% per year return and 8.20% per year standard deviation. Even with 50-50, your money could have doubled in 10 years, and farther out you go, you can still double plus, okay, and standard deviation goes up. So you have to figure out from this table where do you want to operate, okay, what comfort standard deviation level you are comfortable with. Let's continue. Let's continue. And in the table on previous page, STD is standard deviation. Okay? And stocks consist of Vanguard Total Stock Market Fund, which is a US funds, Vanguard Total International Stock Fund, which is a non-US fund, and for bonds consist of one fund, Vanguard Total Bond Fund. Okay, let us continue. And such that US to non-US ratio is 2 to 1. So we have twice as much of Vanguard Total Stock Market Fund as is the Vanguard Total International Stock Fund. Okay, let's continue. So the data we just saw is for this mixture here, US is twice as much of non-US, and for the bonds we only consist of Vanguard Total Bond Fund. And stocks, two funds, one a US fund and one is a non-US fund. Let's continue from here. Let's continue. We're next section here. In this section, we will discuss basics of portfolios. Okay, let's continue. And then simple. After that, we do sample model portfolios. Then after that, rules of thumb for portfolio construction. After that, building passive portfolios. Then selecting funds. We'll do the really heavy duty work here. When you select the funds, then you are close to getting yourself a decent portfolio. Okay, then build the active portfolios. That will see how do we use selected funds to build the active portfolios using these rules of thumb. Let's continue here. Now you see a portfolios designed by an engineer. I'll show you how I design a portfolio and give you the results. Okay, let's continue here. Let's continue with basics, and topics we will cover here are who can benefit, who is the target audience. Okay. Next is what's a portfolio. Next is what are core and satellite assets in a portfolio, and what are strategic and tactical investing styles, and what's a passive portfolio, what's an active portfolio. Let's continue. Who can benefit? Audience. Who can benefit from this presentation? Let's continue here. This presentation is for DIY, do-it-yourself folks who haven't done any mutual funds portfolios before. It's for those folks, do it yourself. Okay? After section on building passive portfolios, a user can put together a respectable passive portfolio. Okay, continue. After section on building active portfolios, a user should be able to design a decent active portfolio. After section on portfolio design by an engineer, a user can see how I do portfolios to achieve respectable returns at acceptable risk. For me, its risks is more important than returns. We want to reduce the risk and try to achieve a respectable returns at a reduced risk, which is a standard deviation. Okay, let's continue here. Okay. Now we'll discuss, we already talked about who can benefit. this section we would see what is a portfolio. Let's continue here. We know that there are basic assets like equities and debt, and there are also alternate assets too. In the investing world, a portfolio is a collection of assets to deliver best returns at a reduced risk. In we are trying to design a portfolio to deliver best returns and at a least risk as is measured by standard deviation. Let's continue. As you proceed through the presentation, I will introduce you to various model portfolios available online. You may use one of those portfolios without any changes, or you may also try to improve on these model portfolios. Let's continue. A basic portfolio is a collection of various assets to satisfy investor desire of decent return at acceptable risk, which is also tolerable risk. Let's continue here. So in this section, we'll talk about what are core and satellite assets in a portfolio. Okay, let's continue. What's core asset? What's a core? This is structure of a portfolio. Core makes the structure of the portfolio. It usually consists of large cap US value and blend funds and may include large cap foreign value and blend funds also. Let's continue here. On the bond side, these are the bond funds of intermediate duration or total return type bond funds. Okay, let's talk about satellite assets. Okay, what's satellite? These assets hang on to the structure of a portfolio like ornaments hang on to a Christmas tree, and their purpose is to enhance returns, okay, and provide diversification and maybe reduce standard deviation. Okay. Generally, small caps outperform large caps, so addition of small cap would improve the returns. Gold holds value during uncertainty, so it would hold values, and also gold does not correlate well with either with equities or with the debt, so this also would reduce the standard deviation. Okay, provide the diversification, of course. Okay, let's continue here. Commodities do well in inflationary environment. Also, commodities do not correlate well either with debt or with equities, so they also help provide diversification and reduce standard deviation. Okay, let's continue here. Okay, let's continue here. So examples of satellite funds would be large growth stocks, because core stocks are large value and blend stocks, mid caps and small cap stocks, international, especially emerging market stocks, junk bonds, high yield bonds. Okay, let's continue here. Real estate, okay, which is alternate asset. Okay, commodities, precious metals, managed futures, market neutral strategies, hedging strategies, and some more. Okay, like that. Let's continue from now. Let's continue next section here. In this section, we would talk about what are strategic and technical investing styles. Okay, we already talked about core and satellite. Now we would talk about strategic and technical. Let's continue here. We also have these strategic and tactical investing styles also, or assets. Okay, let's continue here. This is part of portfolio which you design to reach your goals. This is the main portfolio. Okay, so bulk of the portfolio is strategic portfolio. Okay, let's continue here. Tactically, this is part of portfolio which takes advantage of currently available opportunities. Okay, this is opportunistic portfolio, and this is a main portfolio, strategic portfolio. Let's continue here. Let's continue. Example would be, years ago there was a poison-laced Tylenol scare, and investors had overreacted. That represented an opportunity to buy Johnson & Johnson. Let's continue here. In a buy out offer, if you believe that final closing price will be higher, you can buy the target company. That gives you an opportunity to make some money on this buyout offer. And if you believe that deal will fall through, you can short the target company. And that, for example, at one time Microsoft was trying to buy Yahoo. Yahoo was asking for more money, and then Microsoft was willing to pay, and Microsoft just walked out of the deal. Okay, so in that case, Yahoo stock fell significantly on that announcement. So if you could sense that the that buyout offer would fall through, then you could have made money on shorting the Yahoo at that time. Let's continue here. When Carter was president, interest rates were high, and I believe that 30-year zero coupons represented an opportunity of a lifetime. Okay, at during those days, I was able to get 18% or so on a savings accounts. Okay, so on CDs, some of the CDs I could get 18% or so. Okay? Even money markets I could get 18% in sometimes during those times. Okay, let's continue here. Okay, now we'll continue discuss the next section, which is what's a passive portfolio. And let's continue. We will now discuss what a passive portfolio is. What's a passive portfolio? This is a market-based portfolio. In these portfolios, managers do not make buy-sell decisions. These decisions, which are buy-sell decisions, are governed by the construction of the underlying index, underlying market. Let's continue from here. Within mutual funds portfolio universe, these are portfolios of index funds. So passive portfolios are portfolios of index funds. Let's continue. Here is an example. The simple investment portfolio at this location here, Kiplinger's portfolios list, is a passive portfolio. Okay. Simple investment portfolio at this location is a passive portfolio. Let's continue. Let's continue. Now we'll talk about what is an active portfolio. What's an active portfolio? What is an active portfolio? Within the universe of mutual funds portfolio, this is a portfolio actively managed funds. Okay? It's active because we are using actively managed funds to implement the portfolio. Let's continue here. And here's example. Schwarz portfolios at this location are active portfolios. Okay, let's continue from here. Okay, let's continue to the next section here. So far we have done assets, section on assets, section on basics of portfolios. Now we'll talk about sample model portfolios. Next section would be rules of thumb for portfolio construction and building passive portfolios. And to build active portfolios, we would need to do it, select some funds, and then we would will share how I do a portfolio design. Okay, let's continue. Okay, let's see what we do. Why do we study model portfolios? Okay, let's see what happens. Okay, we expect to learn from this. Okay, how experts do portfolios. So these model portfolios are done by some experts, and we learn how experts do these portfolios. Okay, and do they do match a growth fund against a value fund, or do they use blend funds? And do these portfolios are heavily on large caps, mid cap, small cap, construction, etc. And what's kind of mix of large cap, mid cap, and small cap with these portfolios use? Okay. And how much non-US international funds they have? And do they use any alternative funds? Okay. Alternative assets. Let's continue. So we're trying to do how the experts do portfolios. Do they try to match a value fund against a growth fund? And what kind of mix-up of large cap, mid cap, and small cap is? And how much non-US assets they have? And do these fund portfolio use alternative assets, okay, like gold and precious metals, or maybe managed futures? Okay, let's continue. Okay, from this portfolio we can decide if these serve our purpose. Okay, so if we look at the portfolios, we can decide if they will serve our purpose. Can we use this portfolio as these are, or maybe with minor tweaks? Or do we need to design a portfolio from scratch? It's like buy and build decisions. We look through these portfolios online, these model portfolios, and see if these are any good for us. they serve our purpose or not. Do I need to rebuild the whole portfolio, or can I do a minor tweaks? So uh, more portfolios serve their purpose, and we can look them up for use in our portfolios. Okay, let's continue. Okay, we'll study the following model portfolios. Okay, and first and foremost is lazy portfolios. Then Kiplinger's model portfolios. Kiplinger's Personal Finance magazine has put together a number of model portfolios online. Okay, and we do Schwab's portfolio. Schwab has put together some 5-6 portfolios online. Okay, and then we look at a Betterment portfolio. Then we look at portfolio we got in the other video. It's a cheat sheet video, and that's the link on a YouTube. Let's continue. So let's look at lazy portfolios. Okay, the least maintenance cost portfolios are the lazy portfolios. You build them and forget them and just go once a year or so and do rebalancing. That's all required. These portfolios are fine for most folks. And the reason is you're too busy and life is a lot more than finance. Unless you really love tweaking with the finances and our mutual fund, do research, you get these portfolios from. These are about the best portfolios. They have 8 portfolios in this section, and a couple of them are really decent portfolios. Okay, you get these portfolios from, this is the link, marketwatch.com/lazy portfolio. Let's continue. And there are 8 portfolios at the site, and we look at 3 of those portfolios in this discussion here. Let's continue. Here is the lazy portfolios, and here are the 8 portfolios on the site. Very first one is Aronson Family Taxable Portfolio, okay, and Fundamental Fund Advice Ultimate Buy and Hold, Dr. Bernstein Smart Money. Fourth is Coffee House Portfolio. Fifth is Yale University's Unconventional. Then there is a Dr. Bernstein No Brainer. Dr. Bernstein has two portfolios here. One is for Smart Money, there is No Brainer, and Margaretville and second graders portfolio. This is the easiest portfolio here, and if you look at the returns here on 10-year column, second graders have returned the best 10-year return, and Aronson family had 8.15%. But considering this is a 90% stock and this is 70% stock, this I believe is a better portfolio than this one. Okay. Look at a coffee house portfolio, has done rather well. This is 2. Let's continue. Okay, let's see what second graders portfolio is. It's a consider of 3 funds: Vanguard Total Market Index, okay, Vanguard Total International Stock Index, and Vanguard Total Bond Market Index Fund. Let's continue. Its allocation is 10% to bonds, and that's because of the investor age. And here is a reference here. T. Rowe Price has done a study to indicate that stocks have not lost money during any 10-year period. As such, for 11 plus years of time horizon, T. Rowe Price just 80-20 portfolio, and this portfolio only have a 10% of the bonds. It's a 90-10, okay, portfolio. Okay, let's continue. Let's continue here. We note from the portfolio that bonds are 10%. That's income portion of the portfolio is 10%. U.S. Stocks are 60%, so domestic allocation is 60%, and international allocation is 30%. From that we know U.S. is 60%, non-U.S. is 30%. Ratio of U.S. to non-U.S. is 2 to 1. So allocation to U.S. is twice as much as allocation to non-U.S. Let's continue from here. We can use this portfolio as a template and build a portfolio for another risk level. 10% is taking a bond, is taking high risk. It's a risk return uh, plot we had. So this is a riskier portfolio. That means 90% of stocks is a higher standard deviation. So we can tone down the deviation, still use this portfolio as template. So if we were to do 60-40 portfolio, okay, what we'll do, we'll get bonds at 40%, stocks, US stocks is 40%, and non-US stocks is 20%. Here's a 2-to-1 ratio here. US to non-US is a 2-to-1 ratio, and 40% is my allocation to bonds, as we were trying to do 60-40 portfolio. Let's continue from here. Okay, so we know bonds 40%, US stocks 40%, and non-US stocks is 20%. Let's continue. That would be 60-40 portfolio on second graders portfolio. So we use second graders portfolio as template, and we built a 60-40 portfolio using a US to non-US ratio of 2-to-1. Okay, let's continue here. Note, if you note here, when you try and buy these Vanguard funds here, if you do qualify, and qualification currently is $10,000 minimum investment in an index fund. As of today, 28 July 2014, you should invest into lower cost Admiral shares. So Vanguard has a investor shares and also have something called Admiral shares. Okay, Admiral shares, these shares are less expensive, are cheaper. So if you do qualify, you should try to get into Admiral shares. Let's continue. Let's continue here. We're going to look through Aronson's family portfolio. Okay. Link for that is that one, which is a marketwatch.com/lazy portfolio/Aronson family taxable. Okay. And that portfolio consists of US is 40%, non-US is 30%, and bond plus cash is 30%. So US to non-US here is 4-to-3. In the second graders portfolio, it was 2-to-1. Here it is 4-to-3. Let's continue. It's 70-30 portfolio with a significant concentration in non-US stocks. Okay? 30% compared to 40% of US. Let's say significant concentration in non-US stocks. Let's continue. The portfolio contains this thing. This is a VPACX 15%, VISPX is 15%, VFINX is 15%, that's VEXMX 10%, VUSTX is 10%, VEIEX is 10%, VWEHX is 5%, okay, and VISGX is 5% too, VEURX is 5%. VTSMX is 5% and VISVX is 5%. That's 15, 15, 15, 45 plus 30, 75. So 80, 85, 90, 95, 100. So we get 100%. There are 11 entries in the portfolio. Okay, let's continue. Okay, the portfolio of coffee house portfolio is at this location here. Okay, and this portfolio consists of Vanguard total bond market fund 40%. Okay, Vanguard small cap value index fund is 10%. Vanguard real estate investment trust index fund is 10%. Vanguard total international stock index is 10%. Vanguard 500 index fund value is 10%. Vanguard value index fund is 10%. Okay, Vanguard small cap index is an AESX. This is the only one that does not have start with V here. Let's go through now comparison here. Okay, by far the coffee house portfolio, which is 60-40, is about the best risk adjusted returns here. Okay, so this is this secondary portfolio, okay, which has a low return and lower risk. Okay, so this is a high best return risk-adjusted returns here, and Arnson family has a higher risk, slightly higher risk, and also has a higher return. On 10-year basis, Arnson family, which is 70-30 portfolio, has a better returns, and Coffee House, which is 60-40, which has a better risk situation here. Okay, let's continue. Okay. So from chart on previous slide, Coffee House portfolio is about the best on risk-adjusted basis. And over 10-year period, as July 25th July 2014, Arnson family portfolio, which is 70-30 portfolio, has best return of the three we compared. Okay, let's continue. Now, we're going to go look at some portfolios by Kiplinger's Personal Finance magazine. Okay, let's continue here, and then after that we'll look at the other portfolios here. Let's continue. Let's look at the portfolios here, and these portfolios are at this place here, kiplinger.com/tool/investing/T052 S001 investments portfolio finder index.php. Okay, let's continue. We'll consider the following portfolios. It has about 10-12 portfolios. We will only look at some of those. Okay, one of them is low minimum portfolio. We will look at. Second thing we will use low cost expert portfolio. Third we will look at is from Kiplinger 25 list, we will look at portfolio for 6 to 10 years away, intermediate midterm portfolio. Okay, first we will look at low minimum portfolio, okay, which is at Kiplinger site, okay, and this is location here, okay, and which is a question mark portfolio select equals low min, okay, so this is the link for that portfolio. The portfolio consists of two funds, a mana fund, a mana income fund, AMA and X, 60%. In the portfolio it was 70%, but we are doing 60-40 portfolio, and the more portfolio was doing 70-30 portfolio. Okay, let's continue here, and then there is a bond fund here, Homestead short-term bond, and it is 40% we have, and the portfolio had 30%. So we're doing 60-40. 60% is in mana fund, and Homestead is 40%. Okay, if you want to do X-ray on a mana, you'll find out it's a lot of cash in here. Okay, so at least it's not all stocks. It has so this portfolio is, even though we say 60-40, it's probably like 50-50. Okay, let's continue. Let's continue. So next we would look at next portfolio here, which is low cost expert portfolio. Okay. And then after that we look at the other portfolio for intermediate term. Okay, let's look at low cost expert portfolio. Okay. And the portfolio is Vanguard 500 index 25%. Vanguard total market bond market index is 25%. Vanguard total international stock fund is 20%. Vanguard small cap index is 15%. Vanguard inflation protected fund is 10%. So far get 25, 25, 50, 70, 85, 95, and some more. And real estate index is 5%. This is the only fund doesn't start with N, others start with V's, and as usual, when you can qualify, you go for Admiral shares, not the investor shares. Investor shares have a higher expense ratio, and Admiral shares have a lower expense ratio. Let's continue. Now we look at next portfolio, which is a Kiplinger 25 from KIF 25 list, and 6 to 10 years away, and the portfolio. That's intermediate term portfolio here, and that portfolio is at this location here, and the portfolio is Fidelity New Millennium 25%. This is my large cap. Okay. Acre Focus, a KREX 20%. Okay, and that's a double line total return fund is 15%. The double line total return fund is new, has about 3.5 4 years of history. Okay, and Dawson Cox International is 15%. Osterwise Strategy Income Fund is 10%. Okay, and Harding Loevner Emerging Market is 5%. So with 25, 40, 45, 60, 75, 85, 5%. So 90% accounted so far. Homestead Small Cap is 5%, and Fidelity New Market Income is 5%. So we all got 100% so far. Okay, so Fidelity Income Fund, New Millennium 25%, Acre Focus 20%, Double Line Total Return 15%, Dodge Cox International 15%, Osterwise Strategy Income 10%, Harding Loevner Emerging Market 5%, Homestead Small Cap is 5%, and Fidelity New Market Income is 5%. So this is the portfolio for midterm portfolio, and it's the funds are from KIP 25 list. Okay, let's continue. Okay, here's the comparisons here. So this is about the best portfolio we have, Kiplinger midterm, considering the risk and the rewards. Okay, return is for 10-year period is close to 12% here, and risk is standard deviation is less than 11. Okay, this one this is this low minimum, and considering that its risk is less than 8, it's not a bad portfolio either. Okay? And this one is compared to keep midterm portfolio here, this one is low cost expert portfolio is not as good. This one is actually decent portfolio considering it's less than 8% of standard deviation and better than 8% return. Okay? And two funds. Let's continue. Let's compare the notes. Okay, some of the funds have short history. Okay, so the best risk return behavior is for the midterm keep midterm portfolio. Okay, we compare three portfolios, and this is about the best. Okay, expert portfolio use funds with shorter history. When funds have some 45-50 months of history, I don't have a clue how fund would have behaved during a crash of 2008. So when I do my research, I want to see how a fund behaved during the crash. Okay, and when you get newer funds with a shorter history, I don't know how the fund would have behaved during the crash. Let's continue. Okay, now let's go to next type of model portfolio, and which is portfolios from Schwab. Okay, let's continue. So Schwab portfolios are at this link here, and we'll consider this one portfolio, moderate portfolio consisting of large cap 35%, mid and small cap 10%, international 15%, fixed income, which is bonds and cash, 35%, and cash is 5%. 35% is 45 plus 15, 60, then 95 year, and 500%. So we got a large cap is 35%, mid cap and small cap 10%. International is 15%, and fixed income, bond and cash is 35%, and bonds is 35%. Here cash is 5%. Okay, let's continue. Let's see how the Schwab would implement this. Let's continue. And Schwab's portfolio consists of Schwab fund here, Schwab core equity 13%, Lotus, which is also a Schwab company, large cap growth fund is 11%, Schwab dividend equity fund 11%. Okay, Schwab small cap is 10%, and FMI International is 15%. These first four are Schwab companies. Okay. So Schwab is trying to build up the portfolio using Schwab funds. Okay. And double line to return is 10%. Okay, and Metropolitan West is total return 10%. And Baird Core Plus is 15%, and a cash is 5%. Okay, that total adds up to 100%. Okay, let's continue from here. even though I switched to DLTNX by a very similar TGLMX fund, the portfolio has for 2 months of history, which was done on 25th July of 2014. So these have a short history. Some of the funds have a shorter history here. So that means I cannot look at how the portfolio would have behaved during the market crash of 2008. Continue. Okay, now we're going to look at next portfolio. We are look at this first three here. Okay, next one is a betterment portfolio. Okay, let's find out, and then after that we will look at the portfolio we did in a cheat sheet. Continue here. For education purposes, why do I want a betterment portfolio? First thing is I'm an active portfolio type person. Okay, and this is a passive portfolio. So I have small portfolio at this betterment.com, and that portfolio is consists of is ETFs. Okay, betterment.com uses ETF. Okay, some U.S. total stock market VTI is 10%. Okay, U.S. large cap value fund is IVE 10%. U.S. mid cap value fund is 3.2%. U.S. small cap value is 2.7%, and developed markets, this international, is 19.8%, and emerging markets 4.2%. Okay, let's go. And so these two add up to 24%. So 24% is allocated to outside, international. Okay, so it is a 26% is domestic, 24% is international. It's a 50-50 portfolio. Okay, 50% is stock, 50% bonds. Out of 50%, it got 24% to international, and the rest 26% must be to the domestic. Let's continue. High quality bonds, it's a 17.8%, and corporate bonds, liquid 8.4%. Okay, let's continue. And international bonds are 15.7%. So again, out of 50%, 15.7% is international. That's about a third of them bonds is international. Okay, let's continue. And emerging market bonds is 5.8%. So between these two, this is about 21%. 50% is income portfolio, and 21 is international. So 29-21 ratio is. So it's a 42% of the bonds are in international, and 58% of the bonds are domestic. Let's continue. So the portfolio has short history. Betterment is using some of the newer ETFs. So far we have encountered two portfolios with longer history, and those portfolios are Coffee House portfolio, which has better risk-adjusted returns, and Arnson family taxable portfolio, which had a better returns, absolute manner. So returns were better, and risk was also slightly higher. Okay, now we'll have looked through this portfolio so far. Now we'll look at the portfolio we did develop in the other video, the cheat sheet video. Okay. Continue. And in the video, we developed this portfolio, which is Oakmark 13%, PRBLX 13%, FMILX 13%, HFMDX, this is mid cap 2%, WMCVX is 1%, which is small cap. Tweedy Brown Global Value Fund is 6%. Okay. Oakmark International is 7%. Remember that to get Oakmark International, you had to go through back door. You had to go buy that at the fund company itself. Okay, let's continue. And TCW Total Return Fund is 23%. Okay, and then Fannie Ginnie Mae Fund is 22%. So this is my portfolio. Okay, it should be 50-50 when you do the X-ray. Here it only sees 45% into income, but after you do X-ray, you'll find out it is actually 50-50 portfolio. Okay, let's continue. When I do my comparison here, so this is active portfolio which we just discussed, 50-50 is superior to this is Coffee House portfolio, which is 60-40, and also the Arnson family portfolio will be 70-70. So with 50, even with 50% allocation to bonds, this portfolio has outperformed the other two and at a lot lesser risk. Okay, so this is about the best portfolio we have so far out of the three we discussed. Let's continue. Now compare note for 10-year period ending in 25th July 2014, the portfolio cheat sheet video has best return at a least risk. Okay, let's go to next section here. Next section is rules of thumb for portfolio construction. Okay, and after that we will do the four more sections here. Let's continue here. Let's continue here. A portfolio needs to provide a respectable return at a reasonable risk. We build a portfolio with a risk we are comfortable with, and we are trying to get a respectable return from that portfolio. Okay. So for risk return trade-offs slide, we have there is one slide in the fund portfolio cheat sheet video at this location at YouTube. The first variable was allocation to stocks, and this allocation to bonds was 100 minus allocation to stock. Okay, that defines the portfolio. That is our strategic allocation. So our portfolio is governed by our strategy of so much allocation to bonds. Okay, let's continue from here. Further, exposure to international stock and can also enhance returns, increase diversification, and reduce risk. Risk is as is measured by standard deviation. Let us continue from here. Okay, as such, there are two variables we need to consider. How much is allocation to income, and also which by also gives me how much is allocation to equities, and how much is allocation to non-US. In this section, we will discuss allocation to income. Let's continue. Allocation to income section. We can use this return versus risk chart, which I'm repeating again on the next slide, okay, to determine bonds. Okay, allocation to bonds. Okay, we can also use the Vanguard tool or another similar tool to generate portfolio recommendations, and that has bonds allocation, and with this tool uses our risk tolerance to determine our allocations to stocks and bonds. Okay, let's continue from here. Okay, you can also use a rule of thumb age minus 20 for bonds allocation. For a 50-year-old, allocation to bonds would be 30%, and that's appropriate age-based allocation. It used to be for 50-year-old, 50% allocation to income was considered appropriate. Now we live longer, and as such, a lower allocation to income is considered appropriate. You can use another allocation. Okay, you are comfortable with. Okay, let's continue. For this discussion, we will use a 60-40 allocation, where allocation to income is 40% and that to equities is 60%. Let's continue from. Here's the table I've been talking about, and the first column is allocation to stocks, and bonds are a percentage, and bonds are 100% minus this number here. And here's the return percent per year, and here's the standard deviation of return percent per year, and this is 10-year based numbers, uh, returns and standard deviation, and I did this chart on 14th July 2014. So at 40% of allocation to stocks, returns are 6.75% per year based on 10 years ending in 14th July 2014, and standard deviation is 6.67%. At 40% allocation to stocks, return is higher than the standard deviation is. But at 6.75% per year, a portfolio will not double in 10 years. But when you get 50-50 allocation, returns are 7.1% per year, and at that rate, a portfolio would double in 10 years. And at now we are talking about 8.2% in standard deviation. When you go higher up in the stock allocation, our returns go up, and though marginally, and so do the standard deviation go up, and they go up significantly. Okay, at 50-50, my returns are 7.10% and 100% stock allocation, they are only 8.27%. From 50-50 to 100% stock allocation, I gained 1.17% per year in the return. However, standard deviation more than doubled from 8.2% per year to 17.24%. So it is a matter of how much return you want and how much standard deviation you are willing to accept. At 70-30, it's a standard deviation is 11.55%. Okay, let's continue from here. So I actually find for this range here, 40% stock to 60% stock, a comfort zone, but your comfort zone might be someplace else. Okay? You might be comfortable with this 6.3% per year return, where the standard deviation is only 5.31%, or any other numbers here. Let's continue. Why do we do allocation anyway? We use allocation because we do not know the future. Had we known the future, we'll be investing in the assets with the best future returns. The goal of our investing is to build up a wealth as quickly as we can. In some years, commodities shine. In another years, bonds are at top, and still another year, it's large caps are in. Okay, to not to miss out on opportunities, advisors invest in multiple asset types. This is the allocation in business comes in because we don't know the future, and various asset classes are on top in various years. There's no patterns to determine when which assets would be shining. So as such, we mix up the use multiple assets. Okay? And here is the one we need to consider, be really carefully know, understand. Down markets test our tolerance. We all have a great tolerance until it's tested. In up markets, we all have a tolerances. As soon as market turns down, that's the time our tolerance would get tested. As such, we need to carefully consider risk tolerances in building portfolios. We need to have bonds that have been considered as shock absorbers. We need to build up our shock absorbers in our portfolio. Okay, let us continue from here. Okay, so now we are going to go into the next section here. Okay, allocation to non-US. We already know how much to allocate to income, which is either we use a rule of thumb or we use a risk return versus risk chart, or we use age-based allocation or some other allocations method you use. Okay, now we would go to non-US. How much of the equities to go to US stocks and how much of that to go to non-US stocks. So there's no consensus on this issue here. Is how much to US and how much non-US stock. My opinion, we live in the USA, we earn here, we spend here, and we are comfortable with the local businesses. Most of the US companies are multinational and derive their income from sales overseas. Okay. For income to non-US markets, our own US companies provide some of that because they are multinational and their sales come from other markets. Let's continue. It's my opinion here. We do not need capitalization based non-US allocation. Okay? And non-US stocks do add diversifications. Okay? So let's look at these all the issues involving various. Let's see what gurus call about this allocation here. Okay? Professor Jeremy Siegel in his book, The Future for Investors, suggests 40% of equities for non-US stock. That is the ratio of US to non-US is of 60 to 40. We study the lazy portfolio of Aronson family taxable. Lazy portfolio uses allocation of 40 to 30 allocation. US is 40%, 40 and non-US is 30. It's a 40 to 30 ratio. Okay? In model portfolio, Schwab uses a ratio of 3 to 1. So in a Schwab's model portfolio uses ratio of 3 to 1, and that's a US to non-US of 3 to 1. And T. Rowe Price recommends a ratio of 4 to 1, and sometimes 5 to 1. Okay, let's continue from here. In a 50-50 portfolio, BlackRock's tool suggested a ratio of 29 to 21, which is the US non-US of 29 to 21, which is 58 to 42. That's 58% to US stocks and 42% to non-US stocks. And it kept changing. That's the one day that's the number it gave, and it might give you different numbers on another day. In a 50-50 portfolio, Vanguard recommended ratio of 35 to 50, US to non-US 35, 15, which is same thing as 70 to 30, okay, 70% to US and 30% to non-US. In a 50-50 portfolio, Fidelity used the ratio of 35 to 15, which is US to non-US, 35 to 15, which is same thing as 70 to 30. So this is the consensus here, and that's what we will be using. We'll be using of 70 to 30, 70% to US stocks and 30% to non-US. We will be using US to non-US of 35 to 15, which is also 70 to 30 in this discussion here. Okay, let's continue from here. With these two numbers, we can construct the rules we need. Okay, so first we will figure out how much large cap, mid cap, and small cap are 70% US and 30% non-US. Okay, so I used the Excel tool. I got the premium version at TD Ameritrade. Okay, it's a this thing had 68.63%, almost 70% in US, and 30.21%, almost 30% in non-US. Large cap was 76%, mid cap is 18%, and small cap is 6%. So that gave me a ratio of large cap to mid cap plus small cap of 76 plus 22, 24, which is almost like 3 to 1. So we'll design our portfolios to have a 70-30 allocation, 70% to US, 30% non-US, and large cap to mid cap plus small cap would be ratio of 3 to 1. Further, we will use a bonds allocation of 40% and stock allocation of 60%. Of 60%, 70% is US and 30% is non-US. Of the equities, uh, large cap to mid cap plus small cap is ratio of 3 to 1. Okay, let's continue. From there, I can build a spreadsheet here with 100 is fixed here, and these are the two numbers US to non-US of 70 to 30. That's what 2.333 comes for, and from 60-40 portfolio income portion is 640, and spreadsheet computer 60 here. 100 minus 40 is 60, and US is 70%. So 70% of 60 is 42, and 30% non-US is 30%, and 30% of 60 is 18 here. And large cap to mid cap plus small cap is ratio of 3 to 1, and the total is 60 of the equities, and 3/4 is large cap, which is 45. So 75% of 60 is 45 here, and 25% of 60 is 15 here. So you can build a spreadsheet like that to figure out where everything is. This tells me what portfolio I'm constructing. I'm constructing a 60 to 40 portfolio where US to non-US is 70 to 30 ratio. Okay? And large cap is 75% of the equities, and the mid cap plus small cap is 25% of the equities. Okay, there's formula here, there's formula here, there's formula here, there's a formula here, this formula here, spreadsheet, and this is a constant 100 here. Okay, and these are the two numbers that depend upon which kind of portfolio I'm building. Okay, let's continue with. Okay, let's go to the next section here. We already have gone through these first four sections here. Okay, now we'll go through building a passive portfolio, which we have done some of that before already. Okay, okay, now and after that we will go through these next three sections here. Selecting funds is part of a building active portfolio. So I just split that into the building active portfolio. I split that into one is selecting funds, which I need to do before I build a active portfolio. Okay, and also I will show you how an engineer would design a portfolio. So engineer have to design a portfolio. Okay, let's continue from here. Okay, let's continue. We will discuss the passive portfolios. What are the passive portfolios here? Passive portfolios are market-based portfolios. These are market portfolios and market-based portfolios. Within mutual funds in the universe, these portfolios consist entirely of index funds. You can also build a passive portfolio of index ETFs, but we would use index funds here. We have a portfolio of funds. Let's continue. We still have to consider risk return trade-offs here. We just cannot build a portfolio of all of stocks. We also have to consider risk also. These portfolios do have to address investors' tolerance or risks against loss. Okay, they would have to address investors' tolerance for risks against loss. Okay, let's continue. So we're all happy when the stocks, our portfolio going up. The issue comes in when the portfolio takes a nosedive and can still stand the heat. Okay, let's continue. These portfolios consist of index funds of stocks, index fund of stocks. These are my equities and bonds, and sometimes cash. This is my fixed income. So consist of equities and fixed income. Let's continue. Okay, let's give some example. Let's note what we have read online and other sources. An S&P Standard Poor's publishes studies indicating, on the average, index, which is passive funds, beat managed, which is active funds. However, it assigns star ratings to stocks and funds, so it does tell that some funds are better than the other. Okay, it also publishes various lists: portfolio neutral 25 portfolio, platinum portfolio, top 10 portfolio, and other portfolios. And none of these portfolios is a passive portfolio. So on the average, passive funds beat active funds, but none of the portfolios S&P publishes is a passive portfolio. Okay. Warren Buffett has been purchasing index fund, has been preaching index fund. He himself practices value investing and buy and hold strategy. John Bogle is considered father of indexing. He started S&P 500 fund at Vanguard. He is founder of the Vanguard company also. He has invested large sum in his son's fund, and that fund is actively managed. So that is not passive. Okay, let's continue. So various folks preach passive investment styles, passive portfolios, and they also have active portfolios also they publish. Okay? And Warren Buffett is preaching index funds, but he himself practices buy and hold strategy of value investing. Okay, John Bogle has invested money in his son's fund, which is actively managed and is not passive. Let us continue. Let's continue here, building passive portfolios. We have built passive portfolios before by determining comfort zone on return versus risk chart using age specific allocation to income portfolio. We used that in when we were constructing rules for construction. Okay, using Vanguard's tool for fund recommendations, and we in this tool we entered our risk tolerance specific answer, risk tolerance and time to go, time horizon, and the tool recommended a recommendation which is our passive portfolio, which is and risk based. Okay, we also can use the iShare to portfolio builder tool, which builds a portfolio of ETFs still using the user specific risk tolerance. Okay, and in this video we will build a risk passive portfolio from expected future value. For that we will use this tool, portfolio planner from Morningstar. Here a user or investor enters expected final value and yearly investment, and the tool recommends a investment mix of index fund. It recommends invest mix of index fund, which is a passive portfolio. Let's continue. Caution: This tool uses Monte Carlo analysis, which is still based on past performances. Okay? A user can have unrealistic expectation, and the tool might say it's not feasible. Okay? It's not feasible to build a portfolio to achieve a unrealistic expected goal. Okay? Let us continue from here. Okay, here is the enter. Use this tool here, Portfolio Planner. Start with $10,000 and added $10,000 every year for 30 years. Okay, and I was expecting to make $1 million. It's still within the range of expected values. Okay, however, it's the probability of getting 1.1 million, which is slightly more than this right here, is 50% of $1 million is more than 50%, and 821, which is slightly before this, above this colored edge, is 75%. Okay? So let's continue here. So that means that with the 60% stocks, 36.5% bond, and 3.5% cash, which is 60-40, 60% equities and 40% fixed income, it's possible to accumulate a wealth of $1 million in 30 years by starting with $10,000 and adding $10,000 every year. And this portfolio is of index funds of passive portfolio. Okay? And if you carefully select active portfolio instead, you could improve your probability of achieving $1 million, achieving your goal. And on next higher risk level, which is a moderately aggressive risk level, 80-20 portfolio, you improve your chances of making $1 million significantly. Okay? But we will be considering this portfolio here, 60-40, in this discussion. Okay? So, so we just built that portfolio saying we want to get $1 million in 30 years, start getting $10,000 every year, start from $10,000, get invest $10,000 more every year, and we expect to get in $1 million in 30 years. Okay, so this portfolio would do our purpose. So first thing, its probability of chances of achieving are only slightly more than 50%, but you improve your chances by going aggressive, but we'll stay with this portfolio. 60-40 portfolio we will stay with, and that's what it is. Okay, right here. Let's continue. Here, just for the fun of it, and I added this extra portfolio. If in case you decide to wait for it 10 years and only invest for 20 years to expect to make $1 million. Okay? In that case, you will have to, in same portfolio, you will have to invest $24,000 to start with and $24,000 every year for 20 years to expect to get $1 million with similar probabilities right here. 1.1 million with a 50% probability. Okay? So if you couldn't invest $10,000 to start with and $10,000 every year, you would have a hard time starting with $24,000 and investing $24,000 every year. So sooner you start, the better your chances of attaining your goal are. Let's continue. Well, here's another chart I added just so that you have some knowledge about it. It's not, we already built a portfolio we're looking for. Here is how do you spend our nest egg and will my nest egg last? Vanguard has this tool here, nest egg calculator tool on vanguard.com. And if you expect to draw money for 30 years, start with $1 million and or any amount, it's a 4% portfolio withdrawal. I withdraw every year 4% portfolio, and my mix is stock is 45%, bonds are 45%, cash is 10%. There's 95% chances that I will not run out of funds, and there's 6% chances that I may run out of funds. In my opinion, I believe they probably would be left with $2-3 million at the end of some place in here. This is my personal belief is that you will end up being in here, in this range, $2 to $4 million, most like $2.5-3 million at the end. Okay, let's continue. And this is when the portfolio is portfolio of passive funds, passive portfolios, and if you can manage to get a slightly better return from an actively managed portfolio, you improve your chances of not running out of money even further. Let's continue. Let's do a recap of what we learned. Okay. In this video, you have learned that you can amass $1 million in 30 years with a 60-40 portfolio with better than half probability, chances better than half, and start with $10,000. Invest $10,000 every year. Okay? With the 80-20 portfolio, you can accumulate $1 million with a greater certainty. If you go to more aggressive portfolio, you do improve your chances of accumulating $1 million in 30 years. Note just the portfolio is that's what the tool recommended. 60% stocks, 36.5% bonds, 3.5% cash. That's a 60-40. 60% to stock and 40% to fixed income bonds plus cash. With 60-40 portfolio, you get a better than half probability to achieve $1 million. With 80-20 portfolio, you got a better chances of accumulating $1 million with the same scenario. Start with $10,000 and continue with $10,000 a year. In fact, you can start with it 80-20, and as you grow closer, you switch to less aggressive style, okay? And to achieve your desired target. Let's continue. Lesson so far, by now you should be able to determine structure of portfolio. You have a portfolio and you can subject that to X-ray, and that would get you its construction, how much of the portfolio is in stocks and how much is in fixed income, and also how much is in US stock and how much is in non-US stocks, and also how much is a large cap and how much is a mid cap and small cap. Okay, let's continue. From that, you can build a portfolio of index fund. You can build a representative passive portfolio from a results of the X-ray. Okay, then you can compare this. How does your portfolio you already have compared to representative passive portfolio? Okay, and the tool for that is backtesting tool I have been talking about. And with that information, risk returns and standard deviations, etc., you would have an intelligent conversation with a financial advisor. If you have a financial advisor, and you can have an intelligent conversation with a financial advisor. Okay? If you view a cheat sheet video, you should be able to select funds, put together a decent portfolio of managed funds. So if you want to do managed funds instead, you can watch the video, and that shows you how to select mutual funds. You can also compute, then you have a new portfolio here. You can now also compare portfolios against each other. So 3 portfolios here. One you already have, one a representative passive portfolio, one you just build a representative portfolio of actively managed funds. Now 3 portfolios, you can compare these all 3 performance of past performance, and you can use a backtesting tool again. Okay? So let's continue. Okay, let's continue with next section here. Okay, we already have done this first 5 sections here. Now this section is about selecting funds. Okay, let's continue, and then we have 2 more sections after that. Okay, selecting funds is one of the most time-consuming section here. So we can go through the basics of construction. Okay, rules of construction. We can build a passive portfolio. That's straightforward. We can look through sample model portfolio. That also takes some time to look through all of them or find the one you might like. Then basics of portfolios, etc. Okay, now we would do selecting funds. Let's hold on here. Okay, let's continue here. Morningstar recently ran a discussion on Fantastic 48 funds. For that discussion, it used the following selection screen, okay, which was the funds must beat the funds benchmark since the start date of the longest tenured manager. Okay, must have expenses ratios in the cheapest quintile of the category. Must have manager who has run the fund for at least 5 years. Must have Morningstar analyst rating of bronze or better. Must have positive parent rating. Must have at least one manager with at least $500,000 invested. Okay. Must have overall Morningstar risk rating that's not too high. Okay. Must have a Morningstar risk that's not high, and must not be limited to institutional investors. So retail investors should be able to get into these funds. Okay, so this is the screen that Morningstar used for this discussion on Fantastic 48 funds. Okay, let's continue. Okay, we don't have access to that screen on the basic screener at the free Morningstar site. Screeners at Schwab and Fidelity don't have the options to do that either. TD Ameritrade has a better version of Morningstar screener, and that does not allow me to use the criteria that Morningstar used. Okay, let's continue. So we will use the following to select the mutual funds. Okay, first thing is we will use the US News mutual fund site here, okay, or Morningstar Funds Compare tool, Fidelity Picks, Fidelity Screener, and so on. Okay, let's continue. Now in this section we will go through US News mutual funds tool, and we will use that to find a funds. Okay, so how to do that? Go to the site usnews.com/fund/mutual funds. Okay, then select the large growth. It has a number of categories, and you select the large growth. We are trying to find large growth fund. Okay, then pick enough top funds to find one or two available funds. So let's see what we do. Okay, so these are the funds I picked from the screen here. Delaware Pooled Large Cap Growth Equity Fund, which is symbol DPLGX. Then we picked up Guinness Atkinson Global Investor Fund, Vanguard Prime Cap Fund, Fidelity Large Cap Growth, Matthews 25, Sequoia, American Funds New Economy, T. Rowe Price Institutional Large Cap, Delaware Pooled Select 20, Fidelity New Millennium Fund. Okay, so we picked 10 here. Okay, intent is to find at least one or two funds in the top rated funds. Okay, so I'll pick, if I could buy that one, I'll pick that one. Okay, otherwise I'll go down the list until I find one I can buy. Let's continue. Okay, for that what we do is check the load, availability, and minimum investments for all of the funds. Consider funds, these funds are. So I put together a spreadsheet and say the very first one required $1 million investment, which I don't have, and so I cross that out. Second one is open and require no load, required a $5,000 investment, so that's still okay. The third one was limited to status, so okay, and this one was limited status. This American fund is open, but had a load. Okay, okay, and this fund had $1 million requirement, and this one had $1 million requirement. Okay, and this one is open and has $2,500 requirement. So I'm going to pick this one fund here, IWIRX. Okay, this is the first fund, and if you have a $5,000 too much to invest, then you might pick this one up here, Fidelity Large Cap Enhanced. Okay, let's continue. Okay, first available funds. Okay, so these are the funds we got, which are we could buy. These are the funds that there are no restrictions, they're open, no load, and investments something I can afford. So I'm going to choose the very first one. I'm going to use one growth fund. Okay, large cap growth fund will use one growth fund and two value funds. Let's continue from here. So I'm going. This is what we are going to use in our portfolio. Now you might have other considerations like no transaction fee or lower minimum investments. You will consider these issues in selections. Okay. Okay. Let's go select large cap value funds. Okay. So I'm going to repeat the same for large cap value fund, which is go to usnews.com/funds/mutual dash funds and click the large cap value button here. Okay, let's continue. So I get this picked up 10 funds again, and these are the first top 10 funds. Okay, Vanguard US value investor. Okay, that fund. Then Vanguard Windsor, that one. LSV conservative value, LSV value equity, Fidelity large cap value, Vanguard equity income, T. Price value fund, Huber capital equity income, and DFA tax managed US value. So I got 10 funds I picked up from the screen, usnews.com/funds/mutual dash funds, and I click the large cap value button. Okay. Let's continue. Let's continue. So we're going to check for load, status, and minimum investment. Okay. So I put together a spreadsheet again, and this column BD is backdoor entry if there is a load fund and I want to get into it. I will check in if there is a way to get a fund without paying the load. Okay. So very first fund BVEFX has no load and status is open. Minimum investment is $2,500. I'm going to pick and next one is Vanguard value fund. Okay, VUVLX, and there's no load here, and I don't have to worry about backdoor entry, and it's open. Its minimum is $3,000. Okay? And I'm trying to pick two funds. So I pick these two funds, and you might look into inside deeper into the funds and see if there's something that you would rather have, and these two funds don't have. Okay, so but I just for this video I'm going to just pick these two funds. So top two funds. Okay, let's continue. Okay, we'll use the first two available funds, and these are BVEFX and Vanguard fund. Okay, let's continue. These funds, and I'm going to pick these two. So okay, these funds are available. I could buy, and this is the fund. I will use the first two, BVEFX and VUVLX. Okay, we'll continue and try another tool here, selecting funds tools, and we'll use the following to select, and already use this US News mutual fund site already. Now we will use a Morningstar fund compare tool. Okay, okay, and then after that we'll do Fidelity picks and some other screeners. Okay, let's continue. So open funds compare tool, which is go to the morningstar.com, then you select the tools, then you say compare, and within the compare section pick up mutual funds. Let's compare, do that, continue, and then when you get into the tool, you click that funds comparison ideas. Okay. From that, they'll give you a list of boxes, check boxes, and you select mid cap and small cap funds. So mid cap growth, mid cap value, mid cap blend, and small cap growth, value, and blend. So you check 6 of the check boxes, okay, and then you say submit. Okay. Then after that you say click show comparison. After that you click the score these results. After that you click customize criteria, and I'll show you the picture on the next slide. Let's continue. And after that you say click fund detail, and from drop down menu you select nuts and bolt view. Okay, let's continue. From select top one or two funds we can buy. So there are would give you a open or closed status situation. They tell you minimum investments, exit, and number of years manager has been uh, in the fund. So you look at the nuts and bolts and see which funds you can buy. Okay, let's continue. Then I'm going to select NICS X Nicholas Fund from the list. Other high ranked funds either require high investments or are limited. Let's continue, and let's look at the screen after I customize the criteria. Let's continue. Okay, here's my screenshot of fund compare tool after I customized the criteria. I included 1 year return, 3 year return, 5 year return, 10 year return, standard deviation, high alpha, low long manager tenure, low expense ratio. So I could say low expense ratio and 3 year return I weighted heavily by 10 each. Okay, and standard deviation is 9 next, and the long-term manager tenure is 8, and 8 is 7 is for 1 year return, and 5 year return I weighted as 8. Okay, and 10 years is 5. So with those weights I supplied, and the Morningstar ranked the funds, and its first 10 are here. Nicholas is at top, and that's what we are going to buy. And I can buy that. It's available open, and minimum investment is within my range. Okay, let's continue. So we'll continue with tools here, and we'll use another tool now. Okay, so we already used the first two. Now we'll do a fidelity picks. Okay. Okay, after that we do the screener, and then something else you might want to use. Okay, let's continue. So we'll use screener after that, and then after that you can do anything else you want to. There may be other tools you might have access to. Let's continue. So we are going to use fidelity picks. Okay, so we'll use fidelity pick to select bond funds. We will look for intermediate term bond funds with superior return, 10-year history, and high star rating. Let's continue. From the screen on the next slide, I picked first 5 funds with a 10-year history. These funds are NERYX, TGLMX, JHBIX, USIBX, and MWTIX. Let's continue. So hit the screen here, and I picked up this fund, Loomis Sales Fund, TCW Total Return, John Hancock Bond, USAA Intermediate Term, and Metropolitan West. So I picked these funds. They had a 10-year history. This is my 10-year history column, and there are the numbers here. And next two also had 10-year history, but I just picked the first, these two. Oh yeah, next one had a 5 star. I could pick that up, but this one, next one has a 4 star here. Okay? So let's go. So I just pick this 5 here. Okay? Let's continue. Okay, from that screen, this is the we already did that on previous screen. So these are the funds, 5 funds. Okay, what I did after that, to narrow to the list, I clicked on the symbol and looked at the growth chart. Okay, the funds which behaved well during crash were TGLMX and MWTIX. Okay, so these are the 2 funds. They held on during the 2008 crash. Okay, let's continue. And to avoid transaction fees, if uh, if these funds charge transaction fee, then you may use DLTNX. In fact, I use DLTNX exclusively in my portfolios. Okay, so these are 2 funds we'll pick up use in this portfolio we are going to design. Okay, let's continue. Let's go do another tool now. Now we will do a screener. Okay, let's continue. We will use the fund screener to select international funds. Okay, let's continue here. First, let's discuss these issues with the funds. Okay, the loads we have to worry about, high investment I want to avoid, closure, then great funds get closed, funds are not available through the broker of my choice. Uh, for this reason, the reason I mentioned these issues is my favorite fund, which is Tweedy Brown Global Value Fund, is closing to new investors on 11th August 2014, which is tomorrow. So today is 10th of August, and this fund is closing, and there's no backdoor entry either. So I call the fund company, and it's closed. Close is soft. Is closed for only for new investors. Okay, if you have access to some shares of the fund before, then you can still buy that fund. Okay, let's continue. Now, now what? Okay. Now what do we do? Okay, let's see what we do. First thing is do not panic. Second thing, buy Oakmark International, which is large growth fund, and TD Brown was large value foreign large value fund, and backdoor entry is available, and I did buy that. Okay, okay. Let's continue, and then enter TBGVX on US News Mutual Fund site, and let's give a top funds selection, and you pick the first fund in from the you can buy in that category, and that fund is MFS International Value Fund, and symbol is MGIAX. It's a load fund, but there is a backdoor entry. The fund is available no load from Schwab, and that today is 9th August 2014, and minimum purchase at Schwab is $2,500, which I can afford, and I intend to buy that fund at Schwab. Okay, let's continue. So this is the data for the MFS fund and MFS International Value Fund, and this little thing here said no load and no fee. So this is a no load no fee fund, and its expense ratio is 1.14% extra. You can look through these details here, but what I'm concerned about is or interested is that this is my backdoor, no load, no fee. Okay? I did that chart yesterday. Yesterday was 9th of August. Okay, let's continue. Okay, let's continue. So we already have foreign large value fund we selected previously, and we will now add a foreign large growth fund. My favorite is Oakmark International. Let's continue here. However, I do need to show you a screener. Okay? I will use one from Schwab. The screener at Fidelity is very easy to use and is available without you having to log into the Fidelity. At Schwab, I had to log into Schwab to use the screener. Okay? Now, tools from Fidelity are available free to everyone. For tools from other brokers, you might need to have accounts. Intent of this presentation is not to limit to Fidelity tools. So you can use tools, any tools you have access to, any screener, and Schwab, TD, and Fidelity are having decent screeners for funds. Okay, let's continue and see next slide for my screenshot of the screener result. So next slide is my results. Okay. Okay, now look in here, this is my results, and my screener picked up these two funds, Fidelity International Fund and JOHCM International, which is a large growth. Okay, no load and no transaction fee. Okay, no load and there is a transaction fee. Okay, this is a no load and there is a transaction fee. Let's continue from here. The two funds picked up. Okay, let's go to next slide. Okay, the screener picked up FIGFX, that's the Fidelity Fund, and this is GOHMX Fund. Okay, let's continue. we have been considering Oakmark International. To pick a fund for the portfolio, we will use M star Morningstar Compare tools to uh, to find to pick a fund out of three. We will use this help of Morningstar Compare tools. Okay, its results are on the next slide. Let's continue. We will use Oakmark International because that comes on top in the results from Morningstar Funds Compare tool. Let us continue. So here is my funds compare tool again, and I entered all the three funds that I was considering, and I selected my criteria: 1 year, return, 3 year return, 5 year return, 8 year return, 10 year returns, alpha, manage a 10 year expense ratio, standard deviation. I picked some weights here. Uh, I have weighted manage a 10 year standard deviation, a low expense ratio, and 3 year return, and then I weighted 1 year return at 8 and 5 year return at 8 and alpha at 5. Okay, okay, so and Oakmark, using this criteria, Oakmark International came in at top. Okay, let's continue from here. Okay, so far we have selected these funds here: IWIRX for my large cap growth, BVFAX for large cap value, VUVLX for large cap value, okay, and Nicholas Fund for mid cap growth, Oakmark International for foreign large growth, MGIAX for foreign large value, TGLMX for intermediate term bonds, and MWTIX for intermediate term bonds. So we have 3, 4, 6, and we selected 8 funds here so far. Okay. So we will use these 8 funds in building our portfolio. Okay, let's continue. We have seen that selecting funds for a portfolio is hard. It's not easy, it's time consuming and frustrating at sometimes. You select a fund and you cannot buy that either because it's close to new investors, not available on your broker site, or it's too high initial investments and what else? Yeah, and load also you need to consider. Okay, let's continue. So as such, most folks are tempted to use various lists, and this list might be Morningstar Premier Funds list, okay, and experts list like Money Magazine list or Kiplinger picks, okay, or list from in-house analyst, list from other sources. Okay, so we are tempted to use the lists, okay, from other sources. However, good thing is that we do it once or when our selections fails to meet our expectation. We just use it once, do it the best job we can, and then we don't have to do that again unless some of our funds fail to meet our expectations. Okay, let's continue. Once we use the funds in a portfolio, you should track the funds at least on a quarterly basis. Okay. Further, you need to have inclusion exclusion criteria. It might include something like this: underperforming peers for 1 year, 2 year, or 3 years. Okay. Usually, any decent manager can have a bad year, but if you have 2 bad years, then you need to be careful. Okay, reduce if the returns have been so terrible that it has affected its 3 years Morningstar star rating, then you have to worry about it. Okay, that's another criteria you can use to include exclude. Okay, let's continue here. And maybe manager changes. Okay, if manager changes happen, and then you need to think about you bought the fund because the other manager had been on line for a long time, for a while, and now this manager who has done well by the fund is changing. Then you have to be cons considering, do we keep the fund or do we switch? Okay, let's continue. And maybe some other criteria. That's your own. You have to figure out what matters more to you, and if one of your funds fail to meet some of that criteria you pick up, then it's a time to change the replace that fund with something else. Okay, let's continue. However, you will consider your tax situation in making changes. It's no easy decision to replace a fund because you would need to sell something, and that could be a tax situation, and you have to be careful. So given all that these issues with tax situation, etc., you need to be very careful in picking the funds to start with. You might pick up a second best instead of the top best fund, but pick up the fund that's more consistent than the others are. So that might avoid this nasty tax situation, or at least reduce that tax situation in future. Okay, let's continue. Let's go to the next section here. We have already discussed these sections, first 6 sections here, and this video is going to, this section is on building active portfolios. We already know the funds, we all know the construction rules, and we would build a active portfolio using these funds we selected here. Let's continue. So portfolio design by an engineer will do after that. Let's continue. Let's continue. Let me share frustration with you. We had picked MGIAX for large value fund, and I tried to buy that at Schwab, and it is available only to institutional clients. So I could not buy that fund even though it said no fee and no load on their data sheet. Let's continue. So for this exercise, we'll go with the same fund with B shares, which charges load over the years. Instead of charging front load, it charges them 1% a year until the load has been paid in. And if you sell the fund too soon, usually before 5 years, then there is a back end load of the load you have not paid already in. Okay, let's continue. So this allows you to get in without a hefty load chart in the front. For large value funds, and look through the premier list, and there have a four large value funds in that list are either have a 3 stars or fewer stars. So those are, I don't go with a fund which have 3 stars or fewer stars, but it's up to you. You might feel comfortable going with a fund with a lower star rating. Let's continue. If you care to just diversify, you can use this ARTIX, which is a foreign large blend value fund. Okay, we will try to look for a large foreign large value fund, and this one is a foreign large blend fund. Okay, it's a decent fund, ARTIX. Okay. As far as I know, this fund is available as of today, which is 13th of August on 2014. Let's continue. Let's continue with building portfolios here, and in this section we will do what? Build a shortcut portfolio. So we will, and then in a later section we'll build a 60-40 portfolio to meet our ratios. Okay, then we'll dry run the portfolios built so far. So we'll dry run these two portfolios. Okay, let's continue. Let's do a shortcut portfolio. Continue here. So we know these are the selected funds. Okay. IWIRX for large cap growth fund, and BVEFX for large cap value, and VUVLX large cap value fund, and we get 2 value funds and 1 growth fund. And ICSX is mid cap growth, Oak Mark International is foreign large growth, and MGIAX, actually BX, is our foreign large value. Please continue. And TGLMX my intermediate term bond funds, and so is MWTIX is intermediate term bond fund. Let's continue here. Target allocation is US is 42%. That's what we are trying to achieve. Non-US is 18%, and fixed income is 40%. Let's continue here. The US funds are, these are the 4 funds we have. So we need 42%. I got 10.5% each to all the 4 funds. Another thing is that the first 3 are large cap funds, and the 4th one is a mid cap fund. We also are trying to achieve a ratio of large cap to mid cap and small cap of 3 to 1. So that served me just fine. I got 10.5% each in all four funds, and it gets me 42% to US funds. Okay, let's continue. Let's continue, and we already have a allocated allocation to US funds. Now we will do a non-US funds. Okay, and we have these two funds for non-US, Oakmark and MFS fund here, and this is a need 18%. I just gave 9% each. Okay, 18% to two of those, 9% each. That's a shortcut portfolio. Now again, we have US 42%, non-US 18%, and fixed income is 40%. And we already have this US and non-US allocated. Now we will do a fixed income funds. Okay, we have two funds, a TGLMX and MWTIX. Need a 40%, it's 20% each to both of these funds. Okay, let's continue now. So we have our portfolio now is IWIRX 10.5. These US funds all 10.5%, and these domestic international funds all 9% each, and the non-US 9% each, and the bond funds are 20% each. That makes my easiest way to build a portfolio given a set of funds we selected. Okay, let's continue. Our portfolio is US is 36% from the X-ray, and non-US is 22%. And in fixed income is 40%. That's on target here. Okay? And others are 2%. So equities is 58%, and we were looking for 60% and 2% other. Okay, so we got that one here is short than our target is. Okay, and also large cap is 73%, mid cap plus small cap is 27%. That ratio is fine. Large cap to mid cap and small cap is, we're looking for a ratio of 3 to 1, and that's close enough. Okay, let's continue from here. Okay, another thing is here, US is not as much as we care for. We're looking for 42% and 18% here. A ratio of the two is 7 to 3. So this ratio is not 7 to 3. Okay, it's less. Non-US is more than our target is, and US is less. Okay, let's continue. So this portfolio has less US allocation and non-US allocation, and more in non-US allocation. So this fund portfolio has less in US allocation and more in non-US allocation than we had planned. So it's not the portfolio we planned, but we'll do it. This is a shortcut portfolio. Okay, let's continue. Let's continue. Okay. In this section, what we'll do, we will build a 60-40 portfolio to meet our ratios. So we used a shortcut portfolio before, and which had too much of the non-US and not enough of US allocation. Now we would build a 60-40 portfolio that does have the proper ratios, okay, are the ratios we are looking for. Let's continue. And after that, we would do a dry run of the portfolios built so far. We will do a back test of the portfolios. Let us continue. So first we would need X-ray data for the portfolio. Okay? And this is what we have. We have, these are the funds we're considering, and this is their allocation. Let's say US is that much, non-US and bonds, like cash and other, and large cap, mid cap, and small cap. Okay, let's continue. So we would need this uh, X-ray data of the individual fund, and to properly build up our portfolio. Okay, let's continue. Okay, so now we are building a designed portfolio, and by trial and error I got this following allocation in 20 minutes or so. Let us continue. So first we did IWIRX 14%, BVEFX 13%, VUVLX 13%. Okay, let's continue. And I got Nicholas Fund 8%, and Oakmark International 9%, and the MFS International Fund is 4%. I got this smaller than the oak markets because we were using B shares. They are expensive shares than the A shares on load waived basis. Let's continue. And TCW fund 31%, and you may use double line total return fund instead. Okay, let's continue. I use that fund instead of TCW total return fund. Okay, so we use it, but TGLMX has a longer history, and the manager of double line fund used to manage TCW total return fund. Let's continue, and that's a Metropolitan West fund 8%. Okay, let's continue from here. Okay, now do X-ray of this portfolio we just built, and X-ray of the portfolio is US is 40.59%. We were looking for 42, so I got a 40.59%. US is non-US is 18.24%, and I was looking for 18%, and I got 18.24%. Okay, equities are 58.83%. We were looking for 60%, so this is what I got, which is close enough. Okay, US non-US ratio is 2.225, which is within plus minus 0.1 of the 70 to 30 ratio. Okay, let us continue from here. Fixed income is 34.57% for the bonds and 5.17% for the cash. That's 39.74%, which is very close to 40%. Other is 1.44%. That's where the issue is, that I don't have 42% here. Some of that is in here. Okay, let's continue. And large cap is 74%, mid cap is 23%, and small cap is 3%. Okay, and our ratio large cap to mid cap plus small cap is 74 divided by 26 is 2.8461. That's within plus minus 0.15 of that 3 we were looking for. That's close. That's fine. That's close enough, and this ratio is close into what I was looking for, so we do meet our target allocation within the tolerances. Let's continue, and these all are close enough. So it's a portfolio that. Okay, here's the growth chart as of data was as of 12th August 2014, and 129 months is the history I got, and within that month time frame, it annual return was 9%, 9.04%, and standard deviation was 10.12%. So standard deviation was slightly higher, and this is the allocation we had been talking about so far. Okay, and I ran this data on 13th August, and my tool used data as of yesterday, 12th August. Let's go. Okay, here's the comparison of the portfolios we have so far. So design portfolio, which is this square, filled in square, this is right here, had a higher return and slightly higher standard deviation. Returns are on this axis, and x-axis is the risk. High return on a slightly higher risk. Okay, and this is the shortcut portfolio. This is the one we built shortcut which had a excessive allocation to international funds and not as desired allocation to lesser allocation to the US funds, okay, US stocks. So this portfolio is better than this one apparently, and this is the passive portfolio which has similar risk situation but lot lower returns. Return is lot lower. This is the highest return, and this is the lowest return. This is the passive portfolio. This is my Standard & Poor's portfolio, which is a 100% stocks, and it had a high return as expected, and also had a high risk as expected, and lower. Somehow it even got a lower return than the two portfolios we built from the selected funds. Okay? So our select this design portfolio, this one, and also the shortcut portfolio we have has outperformed and Poor's 500 and with a lot lower standard deviation. So this is about 9.5 or so, and that's about 16, about half the standard deviation. We are outperforming the standard Poor's 500. Okay, let's continue. Okay, let's see some questions here. Does this portfolio so constructed maintain its defining characteristics, which is bonds allocation, the U.S. and non-U.S. allocation? We we did went through such a large length to get it right, and does it maintain stay right? Okay, let's continue. Answer: no portfolio is cast in concrete. These are all moving targets. In fact, Morningstar updates data once a month in the beginning of the month. As such, when we use this data, it's already out of date. So, okay, wow, that's bad news that we have built a portfolio on out of date data. Okay, let's continue. However, large funds portfolio is fairly stable. When the funds get too much assets in it and they're rather stable, a manager takes months to unload or build up a position. I suggest that you revisit allocation once every year. Okay, that also gives you opportunity to consider more promising funds. So don't worry about it. It's fine. It should be fine. Okay, it stays. Let it deviate slightly from the allocation we cooked up. We decided, and let's revisit the allocation again in a year or so every year, and do your rebalancing at that time. So this is my reallocation once a year, and at that time we would get it right again. Okay, let's continue. Let's continue. I ordered a booklet from Ken Fisher about that 15 minutes retirement solution, and that's just that 70% strategic allocation. That's something we already discussed here. We discussed only the strategic allocation. Okay, then they use a 20% tactical allocation. Okay, and 10% individual securities. So Ken Fisher recommends using this allocation. Okay, let's continue. So we already discussed the strategic allocation, and that's what mutual funds portfolio is about. Okay? And for tactically, you probably will identify sectors likely to outperform the portfolio. And for individual security, there is plenty of research available. I don't use either, so I stay with the mutual funds. Okay? The mutual funds are a collection of a pool of funds managed by someone who knows what he's doing, at least who's supposed to know what he's doing, has experience in managing portfolios. Okay, so for tactical, you probably will identify sectors likely to outperform the portfolio. And for individual securities, there's plenty of research available, and I don't use either. Okay, I just stay with the mutual funds. And here's suggestion: follow only what you understand. Okay, so stay with your within some your comfort zone. Okay, that's my suggestion. Okay, let's continue. Yeah, the advisor used to say, hey, let me invest 90% of the money in a reasonable manner, and you can keep 10% of your play money, and so where you can go have fun and try out your ideas. Okay, but it's up to you, your money, and I go with 100% tactical allocation, and none of the fancy stuff like tactical allocations are individual securities. Okay, let's continue. Let's continue with next section here. We already gone through first 7 sections, and next section is portfolio design by an engineer. So let's see how an engineer would design a portfolio. Okay, let's continue. So engineers portfolio design. Okay? An engineer uses a method like decide on target allocation, and we have a 60-40 for this discussion. Okay? research to identify candidate funds. So engineer needs to go through a process, and this process includes first decide on target allocation, then research to identify candidate funds. The next thing we do, run through inclusion exclusion filter. Engineer has to know when a fund is no good anymore, and that gives me exclusion filter, and that gives me a idea when to replace a fund. Let's continue. Analyze to select highly ranked funds. Then we have to go through analysis process and rank them and assign scores to various funds and then select the highly ranked funds. Okay, so we're going to select a highly ranked funds. Okay, let's continue here. Then we synthesize that. Synthesis for optimized target allocation. Then we have to do a target allocation which is 60-40 here. We will try to optimize the allocation. Let us continue and then verify the risk reward back test portfolio, that what kind of risk I'm getting and what kind of reward uh, what kind of risk I'm taking for what kind of reward I'm getting. Okay, let's continue. We do a back test the portfolio. Let's continue. Let's continue with the design here. Okay, it's a process. We start with research, then we go through filter. We do research for candidate to decide candidate funds, then filter them for inclusion and exclusion. Okay, let's continue. Okay, so research, we will build a list of candidate funds. Okay, then we'll use a filter to drop out some of the funds which failed the test. Okay, let's continue. Okay, then we'll score them to and assign a score to the fund. We get a scored funds here. Okay, let's continue from here. Okay. Then this section we have covered already, so we get the score funds come in here and they go through optimizing allocator. Okay, let's continue. So this is score fund and we go through optimizing allocator. Okay, and in the end we have a optimized target allocation. Okay, so we would have a target allocation that meets our requirements and it's optimized in some sense. Okay, let's continue from here. Let's go discuss one at a time. So research, will do funds research. Okay, and then what do we do? Okay, so we look at the funds mentioned on morning start discussions. Okay, we'll do a look at one source funds from Schwab. Look at the fidelity picks. We'll do a various screeners results. We'll do a Morningstar funds compare tool for ideas, and we'll also use US news funds for ideas for candidate funds. Okay, let's continue from here. Then in the end we get in a candidate funds. Okay, let's continue. So research is, we look at all the sources of information which would give me a list of mutual funds to consider, and then we would look through research and use them for research, and we have a candidate funds. Okay, these are raw funds. These are total list of the funds we want to consider. Okay, let's continue. Okay, let's continue. We start with the process analyze and score. Okay, and feed up with this thing with candidate funds, and then feed in stats alpha, beta, r squared. This is a modern portfolio theory stats. Okay, then we feed into that returns and standard deviation, Sortino ratio, bear market percentile rank, upside market capture, downside market capture, tax efficiency. Note, analyze and score use these and other stats to assign score to candidate funds. This list is not exhaustive, and in future I might score the funds differently. And you should have your own mechanism too. Intent is to rank and use higher ranked funds in building portfolios. Okay? So this process here, analyze and score, uses all these stats and maybe more, and result in a fund with score. Now we have a funds which have a score. Okay, which we score we assign. Okay, let's continue. Now are going to last process, optimizing allocator. Let's continue here. Our primary issue is to use selected funds to build a portfolio to match our constraints of US is 42%, non-US allocation is 18%, fixed income is 40%, large cap to mid cap plus small cap ratio is 3 within plus minus 10%. US non-US is 3 within plus minus 0.1. And what do we have? We have mutual funds. Most of these funds do not stay within the themes. There is asset bleed. You can get non-US exposure from US funds and vice versa. Similarly, you can get in a fixed income exposure from an equity fund. Okay, let's continue. Challenges and opportunities. They represent a challenge to create target portfolio. So if you do a shortcut type portfolio, we noticed that it was heavy on non-US equities and lean on the US equities. So, and that is because of all the bleeding that we ignored in a shortcut to portfolio. However, multiple choices also. Let's continue. So we were talking about this section here. Multiple choice also present. Flexibility to get US, non-US, fixed income, large cap, mid cap, and small cap from various sources. So multiple sources for all these my assets allocations. Okay. Let's continue. Problem. Find a target allocation from selected funds. So this is what we're trying to do. Subject to constraints. So we're trying to find target allocation from selected funds and subject to constraint. First of all, there is asset bleed. Then the constraints are, most of the constraints are of inequality constraints, like x is less than y, x is less than equal to y, or x is greater than y, or x is greater than or equal to y. Okay? In such a situation, either constraints are unrealistic and no solution exists. So there is no way we can make a target allocation. There may be some conflicting constraints. Okay, when the constraints are realistic, we should have multiple solutions to achieve the target allocation. So we're not looking for exact solution. We are looking for a solution that meets these inequalities we have, okay, or our constraints. So in that situation, we should have either no solution or multiple solutions. Let's. Okay, this is from previous slide here. From multiple solutions, one solution may be better than other solutions are. Okay? To determine that, we need to define how one allocation is better than another allocation. That makes our optimization metric. Okay? So one allocation portfolio is better than another portfolio. Okay, let's continue. And to find a better optimal allocation, engineer uses linear programming. However, it's a linear. All the constraints are linear. Okay. However, that generates a locally optimal allocation. If you do a linear programming, I'll get a locally optimal allocation, and that allocation depends on the selected initial condition or starting gas. So we would use a linear programming. However, that only gives me a local optimal solution, and I'm trying to find a global optimal solutions. And this solution depends on the selected initial condition. Okay, let's continue. So we have already talked about this section here. This is a repeat from the previous slide. Okay. For a global optimal solution, engineers use Monte Carlo simulations to find allocation from numerous initial gas values. After that, they select the best from all of the solutions. Okay? So we start with the multiple or numerous of the simulations, and then from each of the simulations, when there was a solution, we find out the best allocation given our optimization metric. Let's continue. I use homegrown allocator, which is a proprietary tool for that. Next slide attempts to describe that tool. Let's continue. So here's optimizing allocator. Okay, and selected funds go in. Okay, that's we need to have selected funds we are trying to use to achieve the allocation. Okay, then we pass an optimization metric in here. Okay, and when I find a superior optimization metric, I'll start using that. I'm using a proprietary metric right now, which I believe is trying to determine a skill of the portfolio manager of a fund. So if I find a superior metric, I will start using that. Okay, let's continue. Then we add all the constraints here, and these constraints are for allocation, mitigating single point of failure, minimum required return, etc., etc. And this single point of failure is for larger allocation like large caps and fixed income allocations. We use multiple mutual funds to for in that space. Okay. We usually use two, three mutual funds for the large cap and a couple of funds for the fixed income allocation. Okay, let's continue. So that's our time. We're trying to mitigate a single point of failure. Any decent manager can have a bad year. So if I had multiple funds in the same space, we would mitigate some of the issues from a managing having a bad year. Let's continue from here. And when we all get massage these things up and allocation goes through its Monte Carlo simulations, I get a target allocation which is superior to other allocations given the metric we use. Okay, let's continue. Now question is, how do I know that it's the best portfolio? Okay, answer, I don't know. Someone else might do it better. However, discipline beats emotion most of the time. So we went through discipline. We avoided the emotions. So we also did the hard work. In any case, our results depend on the use data, which is funds and stats we use, and assumptions I might have used sometimes. So it depends on our data, which is funds and stats and assumptions we might have made. Okay, let's continue here. Can a portfolio designed by an engineer lose money? Answer, any investment can lose money. We assume, calculate risk and expect corresponding returns. However, no one knows the future and no one can guarantee a desirable outcome. So any investment is risk prone and we can lose money. Okay. Let's continue. We have history as a guide to indicate that equities generate 6.5% or so in excess of over inflation over long period of time. So equities generate about 6.5% or so in excess of inflation over long period of time. So we're counting on that history to repeat itself at least in the long run. Okay, let's continue. We will subject the portfolio through dry run. We'll go through dry run to see how it would have behaved during the past 10 years or so. What's the well-designed portfolio? So we're trying to design a portfolio. What is a well-designed portfolio? Okay, and so it's a tough question. It goes back to target allocation. A target allocation gives you risk-reward profile, and that's what we did with a passive uh, growth chart for a passive portfolio. Okay, risk-reward profile. Okay. A design portfolio tries to achieve a superior return compared to the return of a passive portfolio. Okay, and lower risk given by standard deviation. So we're trying to get superior return and lower standard deviation. A well-designed portfolio should significantly improve the desirability quotient of the portfolio, which is return divided by risk. Return divided by standard deviation, we are trying to improve that. A well-defined portfolio should significantly improve desirability quotient of the portfolio, and that quotient is return divided by risk. Let's continue. Okay, 60/40 engineers portfolio. I use some constraints to enhance returns, and the tool produced the following portfolio. Okay, Oakmark 11.8% and IWIRX 35.41% and PRBLX 7.10%. See that the most of the large cap allocation went through the IWIRX fund here, and this is a mid cap growth fund NRCSX, Oakmark International, MGIBX 0.9%, and over this one bond fund allocation 38.93%. to allow the tool to optimize, we have to give it some slack. You can over-specify the problem to the extent of no solution meets the constraints. So we have to give some slack to the tool so that it has some room to optimize. Okay, let's continue. So my optimizing tool gave me this allocation, which does, let's see if it doesn't meet our. So US is for 2.16%, which we were looking for 42%. That's close enough. Non-US is 17.32%, and that's we were looking for 18%. And equities is 59.5%, which is nearly 60%. Bonds similarly are 36% for bonds and 3.74% for the cash, and which fixed income is 39.78%, which is nearly 40%. So 60-40 part matches. Now let's look at the ratios here. Large cap is 76%, mid cap is 21%, small cap is 3%. So this ratio, large cap divided by mid cap plus small cap, is 76 divided by 24, which is close to 3. 75 by 25 is a 3, and this is the one more than 75, and this is one less than 25. Let's say non-US to US is 42.16 divided by 17.32, which is 2.4342, and it is within a plus minus 0.1 of 70 divided by 30. So our ratios all match. We go to portfolio, which at least the ratios match, and let's see what. Now this is the growth chart of this portfolio, and I got 187 months. It has data as of 12th August 2014, and the returns are 8.39% per year annualized basis, and the standard deviation is 11%, and Sharpe ratio was 0.58. Sharpe ratio assumes that a risk-free return of 1%, and portfolio was reallocated yearly. Okay? Let's continue here. It has this my allocation here. Okay? Let's continue. Okay, here is the comparison. This is my portfolio, engineer's portfolio. Okay, right here, and this is the design. This is what we design in the class. Okay, which is, and this one is a shortcut. Okay? So out of these, which one is better? If you're looking for return, this one is better. If you're looking for a standard deviation risk, this one is better. So shortcut is better on risk, and the one we designed with a 60-40 and proper allocation to US and non-US has a better returns. And this one is a passive. Passive has a same kind of risk as that shortcut portfolio is, but smaller return. Okay, and this is a Standard Poor's, had a lot higher risk, and its return is better than the passive, but worse than the other portfolios we have. Okay, here's the data here, year by year, to 2005, 6, 7, 8, 9, 10, 11, 12. This engineer's portfolio, this is design portfolio in class, this shortcut portfolio, this passive portfolio, and Standard Poor's. Okay, in 2005, the shortcut portfolio had the best return. Okay, and in 2006, Standard Poor's had the best too. Okay, and 7 engineers portfolio had 10 best return, and passive was the second best. Okay, and in 2008, shortcut return had the best returns, and passive had second best, and Standard Poor's had the worst returns. Okay, so you look at this one here. So India's portfolio was best in 1, 2, 3, and 4 times. Okay, and was second best once, and twice, second best twice, and the worst once. Okay, designed was never best, but it was the second best twice. Shortcut was best twice, and second best once. Passive was never the best, but second best twice, and three times, and worst was 1, 2, 3, 5 times. So passive was worst more often. Standard Poor's was best 1, 2, and 3 and 4 times, and worst 1, 2, and 3 times. Okay, so you see that in engineer's portfolio was down only worst only once. Okay. Okay, design portfolio was never worst, but never at the top either. Okay, shortcut was never worst, but was at top twice. Okay, and passive portfolio was never at top, but okay, and so on. Let's continue. And I know the engineer's portfolio had the better results, returns. Okay, let's con let's continue. So before I added some constraints for enhancing the return, and my portfolio was Oakmark 9.8% and IWIRX 3.27%, PRBLX to 9.4%, and in NICSX 5.89%. Okay. Oakmark International 2.69%, MGIBX 10.77%, TGLMX 38.18%, and I would rather use DLT and next double line total return series and fund. Okay, let's continue from here. And the return as of that date, 13th August, was 9.34% per year as a standard deviation of 9.19% per year. Return was higher than the standard deviation is for 10-year case and was 60-40 portfolio. If I do a passive portfolios, and that is possible only for a 40-60 portfolio where 40% are stocks. So this we have achieved a higher return than the standard deviation with a 60-40 portfolio. In my opinion, that's superb. That's a great, okay? That's a great portfolio. Okay? So let's continue. But we're looking for returns, and then on the return basis is not as good. Uh, Other portfolio generates a higher return. Let's continue. Okay, added some constraints for positions values. Adding minimum allocation constraints optimize now my allocate return this thing. Bookmark fund 12%. I ask it to give at least 12%. IWIRX 12%. I ask it to give at least 12% of that too, and that left me PRBLX of 23.39%. Nucleus fund 5%. I ask it to give at least 5%, and so on. So that way, here I can make it look like more symmetric allocations. Nothing lopsided here. This is Oakmark 12%, IWIRX 12%, and PRBLX 23.39% ratio of. So this is 24% almost, and these two are 24%. Similarly, Nucleus fund has smaller allocation, and just say give me at least 5%. So I can specify those constraints also. And the 10-year return was 9.53% at a standard deviation of 9.57%. 9.53 and 9.57 are close, nearly equal, and that's a great portfolio. Okay, too, because its standard deviation has not gotten out of hand yet. And the simulation, these results are from this simulation as of 12th August 2014. Okay, let's continue. So let's give some notes here. To optimize portfolio, we can not over specify the problem. We need to leave some slack. That's the only way the optimizing tool can optimize. My initial portfolio was marginally better in returns and far superior in standard deviation. So when I did not added any constraints for return, that was a marginally better in return and far superior in standard deviation. And that portfolio won by not losing much. This is how that portfolio won, by not losing much, which is superb allocation. That's the way we need to go. That do not lose the money. That this portfolio followed do not lose the money principle. Initial portfolio had a return higher than standard deviation. We have talked about that. To extract high return, I added constraints to deliver high return. So I added some constraints to deliver high return, and that also increased the standard deviation. Okay? and it did not hold that well during 2000 crash. My initial portfolio had done held up pretty well during crash, and this one did not hold that well. And here the results are: if you change the returns, higher standard deviation will follow too. So high returns and high standard deviations go hand in hand. Let's continue from here. Okay, we have gone through this process. It should have added some value. All these efforts add value to the design portfolio. First of all is I get a lot better allocation to the target. Our portfolios are matched a lot better with the target than any other portfolio that you can get to using a shortcut method. We do use a superior fund. We go through serious research to locate superior funds. So that also adds some values, and we only keep the high ranked funds. That also adds values. So allocation adds value, and then after that we also optimize. That also adds value. So these portfolios we have been adding values at every step here. Okay, let's continue. So this is a value added superior portfolio when we get out of using all the enhancement processes. When you try to do the best you can at every step, in the end you get a superior result. Let's continue. Okay, the stats of all the portfolio we discussed so far, and the data in this stats is as of 13th August 2014. Okay, I have returns here, I have standard deviation, I return standard deviation and IR, okay, which is information ratio. Okay, let's see what's going on here. For the best returns I have, these are for the engineers return enhanced portfolio. 16.70% for 60/40 portfolio for 3 years per year, and 13.84% for 5 years, and 10.09% for the 10 years. Okay? And the worst returns are for the passive portfolios. Okay, let's look up this. Yeah. Okay, here's the second best returns are of the design portfolios for 3 years and 5 years. Okay, and on 10 years, it's this portfolio here of the engineers constrained portfolio has a second best return here. For IR values, engineer enhanced return portfolio had the best IR values too. Okay. Okay, let's continue here. Let's see now. We already know what return is, standard deviation is. We just don't know IR, and that's discussed on the next slide. Let's continue. Okay. So standard deviation is standard deviation in percent per year and is computed from monthly return values. Okay. And return is investment return in percent per year and is annualized. Okay. And IR is information ratio, which is normalized outperformance. For the purpose of IR, outperformance is from relevant index, which would be passive portfolio in our case. And normalization is with respect to standard deviation of the portfolio under consideration. Okay. So this is the IR. Okay. Okay. And you may use online search for more information. A value of 0.25 for IR is good, 0.50 is very good, 0.75 is expert level, and value of more than 1.0 is exceptional. For 3 years we have a 0.58, which is more than very good, and for rest of them we have a more than 0.25, which is between good and very good. Okay. Let's continue. Okay, let's go some summary and hints, and these are my parting thoughts. And let's see, we start from your broker side. Keep it simple, okay, because you can go find a mutual fund that's not available. So if you start from your broker side, then you know the fund is available. Consider funds for load, fees, availability, and minimum investments. Okay, pick funds for superior star ratings, long history, and superior returns. Okay, let's say you need 3 funds and you pick up 7, then you can rank them. Rank funds and go do the easiest you can do. Use a Morningstar Funds compare tool are US News mutual fund site, or you can go take the hard way out also. You can do harder way, but these you should do most of the times. Check out construction of each selected funds from X-ray tool. So Morningstar X-ray tool, and you can use allocation spreadsheet. We use an X-ray data to achieve target allocations. So you can use, first we know that how much our US is, how much non-US is, and how much is fixed income allocation is, what's the ratio of large cap to mid cap and small cap allocation. Yes, so use all that and X-ray data from the funds to achieve a target allocation. Now you have portfolio you can be proud of. Okay? And we try to use 3 funds for large cap. You feel free to use fewer funds. Okay? Because if your portfolio is smaller, too many funds do not make sense. Okay? And sometimes allocation funds and fund of funds are appropriate in some portfolios. Here is a allocation fund which I have used in the past. It's a Villx fund, VILLX. It's a 65-35. It used to be 60-40 fund. Okay? It says US only allocation. And here is a Vanguard Star fund, which is fund of funds. It's last time I checked recently was 60-40 fund, and it has US, non-US, and fixed income. It was heavier on the non-US side and lean on the US side. The ratio was, instead of 60-40, it was 64-36, I think. 64. Instead of 70-30, it was 64-36. For US to non-US ratio was 64-36 instead of 70-30 we have been using here. So it's very similar to 60-40 portfolio. So if you had only $1,000 to invest, you get decent portfolio with just one fund, Vanguard Star Fund, and keep it simple. Okay? So I know we had 3 large cap funds, 2 international funds, and 2 bond funds, and in my personal portfolio I use a fewer funds. Okay, so keep it simple. Let's continue, and that's it. I sure hope you have a great investing experience, and I sure hope you learn something that you can use.